I'm Sophie Tennyson. I'm a senior investment consultant here at XPS, and I'm going to talk you through what happened in the markets over the first quarter of 2021. I'm going to start by looking at the economic environment and how this applies to different asset classes, then consider pension scheme liabilities, finishing with an outlook. So let's start by looking at the global economic environment. At a high level, optimism continues to drive markets. Developed countries globally spent much of the first quarter of 2021 under restrictive measures that have been reimposed in response to the increase in spread of COVID-19 towards the end of last year. However, global equity markets largely focused on the positive sentiment surrounding the global economy and performed well over the period. This positive sentiment can be largely attributed to two key drivers, which I'll talk you through. Firstly, the pace and scale of the COVID-19 vaccine rollout globally over the period and the data that has supported its effectiveness. More than 665 million vaccine doses have now been administered worldwide, equating to 8.7 doses for every 100 people. The UK and US have had great success, which has significantly strengthened the economic prospects for these two large economies. Also, data from Israel, which has led the way with its vaccine programme, has shown the effectiveness of the jabs and the significant role they will play in getting the world back to normality. That being said, the rollout speed amongst countries has been uneven and the pace of Europe's rollout has lagged, largely due to supply problems and indecision around the safety of the AstraZeneca vaccine. As such, the continent is facing rising new cases and lengthened economic disruption, and this weighed on returns. Secondly, governments and central banks announced continued and significant further stimulus support measures over the quarter. In the UK, the Chancellor used the budget in March to announce and extend various measures aimed at supporting jobs, investment, and the country's recovery from the pandemic, committing to spend £65 billion to tackle the effects of coronavirus. The Bank of England's Monetary Policy Committee voted to keep the bank rate at its historic low of 0.1% and keep policy supportive. In the US, Joe Biden's $1.9 trillion COVID-19 relief package was passed by the House of Representatives, and the Fed's funds rate target remains at its historic low of 0 to 0.25%. Combined with supported policy where rate increases are now not expected until the end of 2023. Focusing on equities, the quarter's performance was predominantly driven by returns over March. Although equities made gains over the beginning of both January and February, they pulled back sharply at the back end of each month, highlighting the fact that the markets remain relatively volatile. UK equities outperformed both global equities and emerging market equities. Meanwhile, there were other prominent business stories. A large container ship ran aground and blocked ships passing through the Suez Canal in March, disrupting global trade flows. And a handful of large banks were hit with material losses due to the implosion of a family office, Archegos Capital, which they acted as prime broker to. The quarter also saw some extraordinary equity price rises for certain individual stocks, as many retail investors focused their efforts to actively buy some of the market's most heavily shorted stocks. The stock that gathered the most attention was GameStop, a US retailer, which saw its price increase by over 1,600% in January. Bitcoin's price has also risen significantly over the period, and as such grabbed news headlines. We wrote pieces on GameStop and whether short selling was a suitable approach for pension schemes to employ, along with a look at Bitcoin and whether cryptocurrency has a place in schemes' portfolios, both of which can be found on our website. Things were quite different in bond markets. Global government bonds sold off materially during the second half of February, and gilt yields have remained elevated since. The yield on the 10-year gilt increased from 0.2% at the beginning of the quarter to 0.9% at the end of March. These substantial yield increases were widely attributed to the same positive sentiment that drove equity prices. In addition, investors are also concerned about mounting inflationary pressures that erode the real return on fixed income bonds. Long-term UK inflation expectation rose modestly, but not enough to offset the increase in UK real yields, meaning that most pension schemes will have benefited by some degree from the gilt yield rise through a material fall in liability values. Sterling investment-grade corporate bonds returned negatively over the period due to the material government bond yield increases, although credit spreads and sales remained relatively flat. High-yield bonds, which are typically shorter maturity than investment-grade corporate bonds, were more resilient to the yield rises, but these still returned negatively over the period despite high-yield credits reducing slightly. So putting that all together, the funding level of a typical pension scheme would have increased over the quarter, owing to falls in liability values due to the government bond yield increases and the comparatively good performance of risk-bearing assets over the period. Our outlook has improved in the main given the success of the vaccine and the weight of capital that continues to flow into markets. In light of this, we have upgraded our view on developed equities from unfavourable to neutral and shifted our view from neutral to positive on private debt and long lease property. We believe there are a number of attractive investment opportunities in the market, and we will be introducing 5 of these at our next webinar on the 28th of April. You can register now via our website or speak to your usual XPS contact. I hope this has given you a clear picture of the key movements in the market over the quarter and what we need to be looking out for in the coming months. For more information on this and other pension investment issues, please see our website.